Good morning, good afternoon, good evening to everyone.
Depending
Welcome
on where
back
you
to
are.
another episode
Depending on where you
of
are.
the Equity Market Update. What investors must know this week.
Absolutely. We're going to start this segment with the S&P 500 weekly recap, echo data of the week, discussion on tech, the technology software sector, and what the heck is going on with the software subsegment. Stock of the week, but we're going to start with one thing first and foremost, the crazy statistic of the week. You know which one that is,
Yeah,
Stefan?
yeah, and this is something that I guess our listeners have started getting used to. The
Oh,
statistic of the week
absolutely.
is something which is always kind of mind-boggling for a whole bunch of people. And so here it goes. A $10,000 investment in the S&P 500 in January 2001, so 25 years ago, would be worth approximately $82,310 by
That's
early
what. That's why when we
2026.
say invest for the long term, don't play short term because it's never going to yield to anything. You always win if you're long term. Full stop.
Yeah,
It's just the way it
yeah.
is. Always. So the S&P 500 weekly recap. The index closed the week with a loss of 1.4%. There was cooler than expected inflation data that actually kind of helped the market, and then didn't help the market because obviously good news is bad news because the market wants to see rate cuts, and obviously in this particular case it should have helped the market. But so we had a sell off in midweek, and then we had again just like the week before some sort of a rebound in technology stocks, software related specifically on Friday. But the primary driver for the downturn of the sector, of the tech sector, was Anthropic just about 10 days ago, coming up with its Claude AI model that basically can write software. And so these SaaS software companies got smacked around between 15 and 20% within a week. So it's been a really difficult week it's been a difficult month really for these sectors. But nevertheless, we had this rebound that I don't think it amounted to much on Friday. Specifically because we're going to get back to that afterwards, but because the tech sector basically is the one that has been leading the market higher for the past a few years, and now with that lack of participation, where is the S&P going to go? So anyways, so the economic data for the last week was 2.4% inflation. We had a better than expected CPI number, but there is consumer spending, which is stagnant. And there's been an uptick in more positive confidence towards the employment market because we had delayed unemployment numbers because we had a 2-day shutdown last week. Again, there's like the third in the last 14 months. And we added 232,000 jobs. The expectations were much lower than that. So that was a positive sign. And so that also can confirm, perhaps a rate cut, that a rate hike at some point if we continue to get very, very strong numbers. I believe they're going to be revised lower, just like previous ones have. So let's see how this plays out because the Fed is still in between this. We're going to cut, we're going to stay on hold, and some data shows that a rate cut is warranted, some not yet, and we'll see where all this goes.
Always so many variables.
Sorry?
Always so many variables.
There's always so many variables. I mean, so look, if inflation is very high, goes up, so which some people expect rates, inflation to go up because, again, they're talking about tariffs. What's been happening is the following. Tariffs have been eaten up by companies for the most part in the last year or so, ever since Liberation Day, or months thereof, and thereafter. And So the problem is that we have some people on one side, some economists on one side saying, look, we're bound to get higher inflation numbers. Some are saying we may have seen the worst of it. And the same thing is with unemployment. So we're right in the middle where, the most crucial economic data is what's about to come next. So let's see what happens next. But in my view, unemployment is going to stay stagnant. I mean, we had an interesting print the other day, but I don't know if that's sustainable. The tariffs, they've been quietly being reversed by the Trump administration. A lot of these, blockbuster numbers that were announced and that were implemented, they've been quietly, they've been quietly taken off because the administration realizes that this is, the 2.4% inflation that we have, that would be 1.8, 1.9 if there were no tariffs. If we have left the tariffs the way they were.
So you're telling us that with the tariffs that had been announced, so I wouldn't really even know what term to use, that had really been announced in such a proud way less than a year ago. There's been a backtracking.
Oh yeah, I mean, look, for example, some in a very quiet fashion, some others. They have been announced. For example, aluminum and steel. Now they've been
with Europe,
with Canada and Mexico. So it's like the administration is quietly accepting the fact that it's a self-inflicted wound. So let's see how this continues to play out. There's also been some movement within Congress. So. The Chamber of Representatives, some of the representatives Republican representatives have sided with the Democrats on trying to limit or to basically block Trump's tariffs on Canada. So again, there's 6 Republicans I think have joined the Democrats in passing this vote. The Senate had already passed a very similar bill a few months ago, so they expect this to pass. And so I'm assuming that Trump at this point is now thinking, okay, if I don't go along here, and I'm widely unpopular given the polls, he's going to have to play ball with Congress. That their primary focus is to be reelected. So, and given what Trump's image is around the world and at home, that's highly unlikely now. So they got to save their butt one way or another. And so they got to show their constituents, hey, listen, I voted for the bill to stop Trump from, inflicting pain on Canada, Mexico, and whatever. So they have to go back to their constituents with something.
It's as simple as that, basically, right?
As simple as that. As simple as that. As simple as that. So now, I wanted to go back to what I hinted at before. The technology sector. That engine has stalled, and it's been, the tech sector. No, not only. I mean, just the Mag 7 account for like 30% of the S&P 500. Correct. So, if you take even the broader tech sector, we're talking about a good 50% of the S&P 500. Now, when the tech sector is the only sector moving forward and dragging the indices to new highs, once that stalls, you start to have a rotation in other places. But what happens when you face the realization that technology is the only sector that's actually been growing within the economy itself?
Yeah, so if that one stops, then
we're looking for
trouble.
Yeah, and so in my view, we're at a very crucial point right now. I mean, I've said that before. I've said that, but now that people start to realize, okay, tech sector has basically not done anything for the past 6 months. It's actually anything. It's gone down, especially software companies, like I said before. What happens now that there's no longer that participation? Is the market capable of going higher without the tech sector? And that's the biggest question. And
basically, you're saying, is the market capable of sort of rotating a little bit and saying, okay, tech sector has been pulling everything for some time. Let's see if other sectors are able to start pulling the S&P 500 a bit more.
But what if the growth in those stocks is not there because of their earnings, right? So you have to see what happens with them, and that might be, like I said before, nothing burger. And in this case, when you go to buy into industrial stocks, and then you realize that perhaps the economy is not doing so well for industrials to flourish. So that's one of the things. Then and this, the market is really stupid. Okay, the greatest humiliator, and its participants are mainly idiots because they want instant gratification. Companies that are like Google, Microsoft, Meta, and all these other, the Mag 7s that are spending billions of dollars on AI and data centers and whatnot. And the markets are punishing these companies because they don't know what they're, how they're going to capitalize, monetize on the spending on this AI technology, correct? So the market, instead of being there and waiting to see what the signs are, they're just throwing the towel before things even happen. So for me, there's a bit of that, and there's a bit of the fact that this is a growth scare in some way, or earnings scare, or monetization scare, whatever you want to call it. So there's that for me, and I think that the tech sector is overdone, especially the software companies are overdone. I think Goldman Sachs sent out this note last week to institutional investors and pointed out which were the companies that were likely to be more affected by Anthropic Claude and which ones were not. And obviously the ones that would definitely not be less affected are the ones that are that require excuse me, hardware, like cloud computing, data centers, because AI cannot create a data center, right? They still need the manufacturing of the equipment, the servers, to create a data center.
So Joseph, with all this complexity and uncertainty going on, how does an experienced hedge fund manager like you govern his decisions on where to invest? What kind of philosophy, what kind of approach do you adopt in these situations?
You sell what you see that is most vulnerable, at least for now. Hedge whatever you think it's just overdone, that you're throwing the baby with the bathwater, and when hedge what you can, get rid of what you think it's either overpriced right now in terms of PE, more vulnerable to volatility, and what the writing on a wall spells. So in my case, I hedged what I could, I sold what I could, and I hold on to the ones I like the most and see what happens. I mean, obviously there's no bulletproof system, but if you have a strong conviction and you've done your homework, you buy into your stocks, and you
after all, we're in for the long term.
Correct.
Right?
Correct. But that doesn't mean that.
Yeah.
It doesn't mean that just because you're in it for the long term, if you get a drawdown of 20% in a stock that you like, that you're not going to add to it. I mean, of course, if you love the stock at 50 and now it's trading at 25, you got to adore it at 25. But
if the fundamentals were right, because otherwise it's just adding insult to injury.
Intelligently, right, in an intelligent way, of course. Now we get to one thing that everybody wants to hear about, the stock of the week. And the stock of the week is AMSC. That's the ticker. It's America's Super Conductor, specializes in developing and manufacturing advanced energy technologies. I love the company. It's in my portfolio. I don't want anybody to construe this as investment advice. Please talk to your financial advisor before you buy anything, because as Peter Lynch famously said, people spend a lot more time researching which washing machine to buy, which they're going to spend $500 on, but then they'll put $20,000 on a stock that they heard somebody on a bus mention.
Wow! So much truth to this.
Yeah,
so much truth to this.
you've got to. So got to talk to your financial advisor about your circumstances and take it from there. Absolutely. Yeah. So the company, American Superconductor leverages high temperature superconductor technology, powered electronics, and enables renewable energy transition, smart grid. I like the company a lot. And actually the CEO is somebody that I don't know him personally, but he went to the same school I went to. And so since I think he's a smart guy. And so the stock, actually, by the way, they reported earnings last week. Stock had a very hard time in the past 6 months because of all this rotation going on, and being it was a mid cap, it went down to small cap, and so it's dancing between being a small cap and a mid cap. So stock jumped 10%. Earnings are much better than expected. So I think the stock has a very bright future.
Mm-hmm.
But then again,
Good.
please do not buy what I tell you, what I say. Just please look at your portfolio, talk to your financial advisor, and ask them, hey, listen, is this stock right for me? You know, just like a pharmaceutical, you know.
Very important question. Yes, everybody's situation is different, so absolutely, by all means, do your own homework and seek the services of a financial advisor, a certified financial advisor.
Absolutely, absolutely.
Mm-hmm.
With this, we leave you guys. We
Yeah.
hope you enjoyed this segment of our show. We will
Not before we remind you and we ask you to kindly please leave a like, subscribe to our channel,
comment
and
share. Share with whoever you want.
Share. Absolutely.
It only helps us.
If you like what you're seeing on a weekly basis, then please do not hesitate and share it.
Yeah, please.
With everyone you know who you think might appreciate.
In the comments, please, feel free to express your opinion, and if you want us to talk about something specific, you have a stock that you want me to take a look at, and mention it on the show, so I can give you my 2 cents. We love to have the interaction. We reply to every comment, so here we are. All right.
Amazing. Good one.
Have a great weekend, everybody.
Yep. Everyone have a good Sunday and have a good start of the week.
Bye.